228 public companies now hold Bitcoin on their balance sheets. Strategy, formerly MicroStrategy, alone holds over 840,000 BTC worth $64 billion. Tesla, Block, Coinbase, GameStop. Whoa, this isn't fringe anymore. It's a structural shift in corporate finance. But should your company do it? As a CFO, I have a very specific take, and it's not what the crypto crowd wants to hear. This is the Faceless CFO. Today, the most requested and most controversial topic on this channel: Bitcoin on the corporate balance sheet. I'll give you the honest CFO perspective, the case for, the case against, the accounting reality, and my actual recommendation. No hype, no FUD, just math. First, the case for why are companies doing this. Reason 1, the inflation hedge. U.S. national debt is now over $36 trillion. The purchasing power of cash erodes every year. Bitcoin has a fixed supply of 21 million coins. A growing number of CFOs are asking, why accept the guaranteed erosion of holding cash when there's an alternative that's structurally resistant to monetary debasement? Reason 2, diversification. Bitcoin has historically shown low correlation with traditional treasury assets. T-bills, cash, investment-grade bonds. Adding an uncorrelated asset can improve risk-adjusted returns without proportionally increasing overall portfolio volatility. Reason 3, and this is the big one, the accounting rules changed. In January 2025, FASB's ASU 2023-08 became mandatory. Companies must now mark Bitcoin to fair value every reporting period. Both gains and losses flow through net income. Tesla, holding 11,500 BTC, recorded a $600 million mark-to-market gain under the new rules. This removed a massive accounting barrier that had been holding companies back. Reason 4, the strategy playbook: issue equity or convertible debt. Buy Bitcoin. Bitcoin appreciates. Stock trades at a premium. Raise more capital. Buy more Bitcoin. A self-reinforcing cycle. When it works. Reason 5, signal value. It signals innovation, attracts talent, and generates enormous media attention. Strategy went from a boring software company to one of the most talked about stocks in the world. Now, the case against. What the crypto crowd won't tell you. Problem 1, volatility. Bitcoin dropped over 50% from its peak in 2022. Strategy stock dropped 52% from its 2024 peak. Your board will not tolerate 30 to 50% swings in treasury value. I promise you that. Problem 2, fair value accounting is a double-edged sword. Yes, you can now report gains, but you also report losses. Every quarter, through net income. Your earnings will swing with the Bitcoin price. Analysts and boards hate unpredictable earnings. Problem 3, liquidity mismatch. You need cash for payroll, rent, taxes. Bitcoin is liquid but volatile. Selling at a loss to meet obligations is the worst possible outcome. Problem 4, regulatory risk. What's clear in the U.S. may be murky in Hong Kong, Singapore, or the EU. Tax treatment varies wildly across jurisdictions. Problem 5, custody and security costs. Enterprise custody solutions add real cost and operational complexity. And problem 6, opportunity cost. That $1 million in Bitcoin could have been deployed in AR automation, hiring, or R&D. What's the risk-adjusted ROI comparison? Let me break down the accounting reality. Before January 2025, Bitcoin was treated as an indefinite-lived intangible asset. You could write down losses, but you could never write up gains until you sold. Terrible for companies holding Bitcoin long-term. After January 2025, fair value every reporting period. Both gains and losses flow through net income. Much more transparent, but also much more volatile earnings. Here's what this means for your P&L. If you hold 5 million in Bitcoin and it drops 20% in a quarter, you report a $1 million unrealized loss in net income. Your EBITDA? Unaffected. It's below the line, but your net profit takes a direct hit, and your board will ask questions. So here's my framework. 5 questions every CFO should ask before putting Bitcoin on the balance sheet. Question 1. Do you have 18+ months of cash runway without the Bitcoin? If no, stop here. Full stop. Question 2. Can you absorb a 50% drawdown without affecting operations? If the answer requires mental gymnastics, you can't afford it. Question 3. Does your board understand and explicitly approve the volatility? Surprise Bitcoin losses are career-ending for CFOs. Question 4. Do you have the accounting infrastructure, fair value reporting, custody audits, tax compliance, internal controls? If your accounting team doesn't know what ASU 2023-08 means, you're not ready. Question 5. Is there a strategic reason beyond quote number go up unquote? Payments, client demand, competitive positioning, or just speculation? My honest recommendation: for most SMEs, don't do it. Your cash is better deployed in operations, AR improvement, and growth. The risk-reward doesn't justify it when you're fighting for cash runway. For companies with excess cash and 24+ months of runway, a small allocation of 1 to 5% of treasury is defensible, but only if you treat it as a long-term position, have board approval, and have proper accounting and custody infrastructure in place. For tech companies signaling innovation, it works as a marketing and talent play, but limit exposure and be completely transparent about the volatility impact on earnings. And one final point: the strategy playbook is not replicable for 99% of companies. They are a Bitcoin acquisition vehicle disguised as a software company. You are not strategy. Bitcoin on the balance sheet is a legitimate corporate finance question in 2026. But the answer for most CFOs is not yet, or not much. Protect cash. Protect runway. Protect margin. If you have all 3 locked down and still want exposure, start small, get board approval, and build the infrastructure first. If this gave you clarity, hit subscribe. New videos every Tuesday and Friday. Drop a comment. Does your company hold any crypto? I am genuinely curious. I read every comment. Next video: how MicroStrategy's CFO thinks about Bitcoin, decoded. See you there.